Benjamin Graham, he's pretty much the father of value investing. But the real question is, how do his timeless ideas hold up in today's, let's face it, pretty crazy world? So let's dive into this and see if we can translate his core principles into a modern-day playbook for navigating all the chaos. Graham's entire philosophy really starts right here with this one idea. He believed you can't possibly know if the market is cheap or expensive today without having a deep respect for just how wildly it's behaved in the past. The past doesn't predict the future, not exactly, but it absolutely maps out the boundaries of what's possible. So that's the big question, isn't it? We all see those charts that always seem to go up and to the right over the long haul. But is that the whole story? Or is there more going on beneath the surface? Let's peel back the layers. All right, first up, we need to shatter a huge misconception. This idea of some smooth, reliable, average return. Because as we're about to see, the market's history is anything but average. This is just fascinating because it breaks market history into completely distinct eras. You had a 25-year period of just stagnation, then a 25-year period of pure chaos, booms and busts. And that was followed by a nearly 20-year rocket ship. So that long-term average you always hear about, it blends these totally different environments into a single number that really doesn't represent any of them accurately. So if the market's movements are so erratic, what's actually driving the extremes? Well, Graham would say it's us. The real danger isn't in the stocks themselves, but in our own collective mood swings. And this right here brilliantly illustrates what's called the rule of opposites. Just look at 1924. Nobody cared about stocks. Enthusiasm was at zero. And wouldn't you know it, that was the single best time to buy. Now fast forward to 1968. Everyone was convinced stocks were a sure thing, right before they fell off a cliff. The lesson here? When everyone agrees, they're usually about to be wrong. This is one of my all-time favorite analogies. If stocks go on sale for 20% off, we rush to buy more, right? It's a bargain. But if our stocks go on sale for 20% off, we totally panic and want to sell what we already own. It's completely irrational. The point is, our consumer brain is smart, but our investor brain, well, it can be its own worst enemy. Okay, so if we can't trust our emotions, what can we trust? This is where we need an objective gauge, some way to measure the market's temperature without getting swept up in the fever ourselves. And this brings us to the CAPE ratio, a really powerful tool inspired by Graham's work. It's designed to smooth out all the short-term noise of the business cycle by looking at a full decade of earnings. So how does it work? It's actually pretty simple. You take the current price of the market and you compare it to the average earnings over the last 10 years. That's it. A high CAPE ratio just means you're paying a lot for what a company has historically earned, which is a really strong hint that the market might be getting expensive. I want you to think of valuation like it's gravity. Now, it's not a perfect law. An overvalued market can stay that way for a long time. But eventually, gravity tends to win. And as you can see, high valuations exert this powerful downward pull on the returns you can expect in the future. Now, let's tackle another one of those sacred cows of investing, the belief that if you just hold on long enough, you can't lose. It's a really comforting thought, but the reality, well, it's far more complex. The myth is that time magically erases risk. The reality is that this belief is built on a foundation of seriously flawed data. Simply waiting longer doesn't eliminate the very real possibility of a major loss. So why is the data so distorted? Well, it comes down to a few key issues. A huge one is that the historical record often ignores all the companies that went bankrupt, which is a concept we're about to explore called survivorship bias. This lumberjack analogy is just perfect. Imagine you visit a nursing home for retired lumberjacks. You might think logging is a pretty safe profession because you're only seeing the few who actually survived it. Stock indexes do the exact same thing. They filter out all the bankrupt and forgotten companies, painting a much rosier picture of the past than what most companies actually experienced. This is the brutal math that defines true risk. A 55% loss, like we saw back in 2008, doesn't require a 55% gain to get back to even. Nope, it requires a staggering 122% gain. Risk isn't just a little volatility, it's the potential for a catastrophic loss that takes years or even decades to recover from. And this brings us to this fascinating paradox. If it were a certainty that stocks would always win over time, everyone would pile in, driving prices up to levels so high that a devastating crash would become inevitable. The very lack of certainty is what gives stocks their potential for higher returns in the first place. So, if history is chaotic, our psychology is treacherous, and the future is unknowable, what are we supposed to do? The answer is to stop predicting and start preparing. You have to focus only on what you can actually control. And this gets to the absolute heart of Graham's wisdom. We cannot know when the next crash will hit or how long it will last, but you know what? We have total control over our asset allocation, our use of debt, and our own investment policy. That's where we should be focusing 100% of our energy. And here is Graham's actual playbook for when those gauges, like the CAPE ratio, are running hot. Number 1, no borrowing, 0. Number 2, stop adding new money to stocks. And number 3, think about reducing your stock allocation to a more conservative 50% maximum. It's a simple, defensive strategy. This quote from Aristotle just sums it up beautifully. We can't demand mathematical certainty from an uncertain field like investing. An educated investor doesn't look for perfect predictions. They prepare for a whole range of possibilities. And that brings us to the ultimate takeaway. The goal isn't to build a portfolio that works only if you guess the future correctly. The goal is to build a portfolio that's resilient no matter what the future decides to throw at you. And that right there is the true essence of being an intelligent investor.